All right, everybody. Welcome back to Strongman Personal Finance. If you haven't already, you better subscribe to my freaking channel because I give you no BS advice that is going to help you achieve long-term financial security and success. Now, today, we are going to be looking at a stock that is near and dear to my heart. And the reason this stock is so special to me is because my investing hero and idol, his name is Chris Sane, supports his followers, which includes me, investing in this fantastic stock. Now, I don't know why he's pumping the stock, or I didn't know until I went on Robinhood Stock, and I looked at the stock's performance in the last year. So far, it's up 1,227%. Now, if you're just a new investor and you see such massive gains like that, you probably get addicted. You're like, wow, there must be something about this stock. I mean, it's got genomics in it. I'm sure Kathy Wood has talked about it. If it went up 1,000% and I YOLO my money into it, it'll probably go up another 1,000%. That's probably the logic of the normal, standard, uneducated retail investor. I decided to do a little bit further digging. So I pulled up the stock's 10K, which is their annual financial report, to see how profitable and amazing they were. And I also looked them up on Morningstar because I got a free Morningstar subscription from my library, which you should check out too. So yeah, Bionano Genomics, it's up, 1,000-something% in the last year. It's down 19% in the last 3 months. And it's up 51% in the last month. That's some crazy volatility, ladies and gentlemen. Maybe Chris Sane is right. Maybe this stock will have another 1,000% return next year because stocks only go up by thousands of percents a year. So let's go look at Morningstar first. Now, like I said, you should sign up for your local library or go to your local library, and they probably have a subscription, which is awesome because you can actually do research for free. And yes, this is my town, Poquoson, okay? If you want to come stalk me, you can. I don't really care. I have a small, boring house. So let's look at some of the amazing ratios because I want to look at the fundamentals of this company. Now, its revenue 3-year growth is negative 3.65%. Wow, that's really enticing, isn't it, ladies and gentlemen? Net income growth. Oh, I guess that means they're not profitable because it doesn't show any growth. Operating margin, negative 379%. And free cash flow, which is operating income less capital expenditures, negative $44 million in 2021. Man, I can see why Chris Sane is so into this stock. Return on assets, negative 20%. Return on equity, negative 22%. Wow, so much good stuff. But one thing I'll always say about this stock is that they have a very low debt to equity ratio. So even though you're investing in a company that's basically bleeding cash and having massive losses every year, at least it's not in debt, okay? That's really good. So Morningstar is a little helpful, but then again, I like to look at the 10K. But before we dive in, I want to zoom in on one more thing here, ladies and gentlemen. This is hilarious. So this little graph on the left here, it shows the company's revenues every year in the blue and the net income in the purple or red or whatever that is. So as you can see, the revenues have been going down and the losses, the net income has been going lower and lower and lower. So this company is just losing money hand over fist. But you know what? It's up 1,000% on Robinhood Stock, so it must be a good stock to invest in. Jesus. All right, let's go look at the 10K. So the 10K, like I said, is the annual financial report, and you can actually glean some information. You can do a lot of math, which I'm not going to do right now. I'm just going to go over some basic stuff about this company. But if you want to invest in a company, you should probably pull up a couple years of 10Ks and look at revenue trends, operating income trends, profitability trends, cash flow trends over years and years and years, because you really have to go deep into a company and understand what you're reading. So if you want to go read this yourself, what I would recommend you read, this is the 10K, you can go and read Management's Discussion and Analysis. This is basically the management talking to you and telling you what they're doing, what they plan to do for the future, and they kind of explain why they had losses. So here I can see right off the bat, we have incurred losses in each year since our inception. We have incurred losses in each... They have a typo, so they say it twice. We have incurred losses in each year since our inception, period. We have incurred losses in each year of our inception. Wow, that's a really professional 10K right there. Bionano Genomics. Our net losses were 41 million and 29 million for 2020 and 2019. So your losses are going up. And they have an accumulated deficit, so that's like their total losses added up, of $143 million. I can really see why this stunk has been going up. I don't know what they're working on. I don't know what groundbreaking technology they're going to do. But looking at this company right now, it's massively unprofitable. I don't care how futuristic and exciting it is. All right, they're a life science instrumentation company in the genomic analysis space that provides tools and services based on its Sphere systems to scientists and clinicians conducting genetic research and testing. But where are your profits, Bionano? It's all about the money. All right, so that's reading that, and they IPO'd in August 2018. Let's go look at their financial statements. But if you want to invest in a company, at least read the management discussion and analysis as a starting point, and then go look in the financials and the notes of the financial statements. So let's go to the financial statements, and let's look at their balance sheet, okay? Now, I didn't see a lot of debt based on Morningstar's report, so I wouldn't worry about this company going out of business. Now, I mean, I do see a massive increase in debt from 2019 to 2020. They borrowed, it looks like, is this in millions? It doesn't say. I think this is actually the number. So they borrowed $16 million of long-term debt, but interest rates are low, so you have to look at the interest expense to really see if that's going to really affect their bottom line significantly. I see goodwill went up by $7 million, which means they bought another company, and the value, what they paid for the company was more than the value of its net assets, which isn't necessarily a bad thing. So, okay, looking at their current ratio, which is their ability to pay off their short-term debts, they have $46 million in cash equivalents, inventory, and their current liabilities are almost $9 million. So this company's not going to go out of business anytime soon because they're probably raising a ton of cash from issuing stock and issuing debt. Now, let's go look at their income statement. So, okay. The main thing I'm seeing here, so revenue is massively decreased. So in 2019, they made 9.4 million, and then it dropped to 6.2 million. Wow. That's a really nice increase, isn't it, ladies and gentlemen? Their cost of revenue went down. Okay, that's normal. Total operating expenses. So their operating expenses have exploded in the last year. And that's because even though their revenues went down, they started investing about $1.2 million more in research and development. And their selling, general, and administrative expenses went up by $10 million. Holy crap. Now, that's something that stands out to me. When you're looking at a company, you want a company to be basically as profitable as possible, as long as they're not, being so stringent with cutting costs that they affect their long-term performance. But it's really shocking to me that their selling, general, and administrative expenses went up by 11 million. I mean, that's pretty crazy. So I would look and see what caused that. It could be anything. But, I mean, look, loss from operations, 25 million, 38 million. Wow. All right. And then their net loss, when you factor in interest expense, which has gone up a little bit, but nothing crazy. Loss on debt extinguishment. Interesting. So their net loss for 2019 was 29, almost 30 million. And then their net loss increased to 41 million. And, okay, this is very important, ladies and gentlemen. Now, when a company issues stock, let's say you buy a stock during an initial public offering. If the company then goes and issues more stock, that's called dilution. And what that means is if a company has a certain amount of earnings, but they issue more shares of stock out, they have to spread the earnings between more and more shareholders. So if you're an initial investor and then this company issues a massive amount of stock, your earnings get diluted. So it's actually a bad thing for a company to be expanding their shares or issuing more shares to the public. Now, if you look at the weighted average common shares outstanding, which I'm not going to go into how you calculate that, they had 14 million, almost 15 million shares in 2019. And then it went up by almost 9 or 10 times. So they've diluted the crap out of the initial shareholders. Because now they have 104 million shares. 14 million shares to 104 million shares. Now, I know the company's has a net loss, so whatever. But if they keep issuing shares like that, if they ever become profitable, that's going to screw you over because it's diluting your equity, your ownership in the company. Wow. All right, let's look at their statement of cash flows. Now, the main thing you want to cue in on is cash flows from operating activities, because a company's cash flows are not represented in the statement or the income statement. The income statement is based on the accrual basis of accounting, which recognizes revenues when they're earned, not when cash is received, and it recognizes expenses when they're incurred, not when cash is paid. So if you want to see the business from a cash perspective, you want to go to the statement of cash flows. You want to look at both the income statement and the statement of cash flows. Now, looking at this, I mean, even here, they had a negative or net outflow of cash of almost $30 million in 2019 for operating activities, which is bad. And then that went up to almost $40 million in 2020. So this company is just freaking bleeding massive amounts of money. It's insane. Now, this company may in the future, grow to, become the dominant genomics company, but it's way too early for you to be investing your money in this company. They're diluting the crap out of their shareholders. They have massive and growing losses, both on a accrual basis and on a cash basis. Did I say they're massively diluting their shareholders? And they're just a freaking wreck. So I don't care what Chris Sane, even though he's still my hero, he's such a good guy. I don't care what he says. I don't care how much the stonk went up the last year. You don't chase performance. You don't go and buy a stock just because it went up significantly, because you probably already missed your chance to make money. Holy crap. This company is garbage. Do not invest in this company, please. Anyway, that's it. I mean, if you really want to read more about this company, cool. You need to download the 10K and look at their financial statements and really read them and understand them. Get to know the management of the company, kind of see where they want to go in the future. There's tons of research you need to do, but I just went over a very brief exercise, and this company is freaking garbage. I mean, just complete and utter garbage right now, and I would not put a dime of my money in this company. Anyway, like, subscribe, buy my book, Stop Being a Broke Loser. It's on Amazon for $3, and y'all have a wonderful, delicious night.